come in from Pradeep Kumar Rawat, and I think this is on the back of what's happened with the recent rate changes, Surya.
Okay.
He says, what's your outlook on the bond market? And the last year and a half has been pretty solid for some of these, some of these offerings, double-digit returns over here.
See, that's simply because you have an inverse relationship between the bond and the yield, in the interest and the yield. And because you believe that the inflation is going down, which actually is happening, hence your investments in funds in bond market starts to benefit. And that's exactly what is happening in the last 1.5 years. So what has happened in this rate cut? Let me just give you a 2 minutes snapshot on this. So my repo rate was cut by 0.25%, which is 25 basis points, and now stands at 6%. So that was expected, and a lot of it was actually factored in the market, because most of the analysts were actually saying we expect a 25 basis points cut happening in the repo rate, and that was exactly what RBI did. So that was factored in. So you didn't see too much of changes happening in the yields on the bond market. But what it invariably did, because people were expecting that the stance being taken by the RBI could be a little softer. But the stance being taken by RBI was status quo. So they were saying we are neutral on the rates going forward. They also believe that the inflation can creep up by 50 to 100 basis points. So with the Q which came out, the gist of the matter of it was that it's going to be totally inflation data centric from here. So if my inflation data becomes on the behind side, it becomes a little weaker, we believe that there's enough scope for a rate cut to happen further. But don't expect a rate cut to happen immediately or in the next RBI meet. Over the next 1 year or thereabouts, expect a 25 to 50 basis points rate cut, which can have an impact maybe on your interest rates, on your housing loans, which you're already seeing an impact. And RBI is really pushing hard banks to reduce the housing loan and likewise the interest rate, the borrowing interest rates. But on the flip side, your FDs or fixed income product assets, the returns also go down. So you have to make sure that investment which you do are a little bit protected. You can't safeguard beyond a point, are protected from a reinvestment risk. That's what I believe is going to be the biggest risk going forward, because what happens when your FD or a bond or any investment matures? How do you deploy that back again? So my FD rate right now is 6.25%.
Yeah.
So 1 year from now, maybe it's 5.5%. That's the risk I carry.